Welcome to the Real Estate Crowdfunding Show, syndication in the digital age at gowercrowd.com. And today you are going to hear from one of the true leaders in the world of real estate syndication, principal and co-founder at Origin Investments, Michael Episcope. Hello, Adam Gower here, and I have been tracking the best of class operators in real estate crowdfunding since the very beginnings of the industry post-Jobs Act in 2012. I don't even recall how it was that I first discovered Origin, other than to say that they stood out for two reasons. One, the caliber of their communication has always been among the best in the industry, and two, they are among the only sponsors to have wholeheartedly engaged in digital marketing to raise capital from the very beginning. The other thing that stands out about Origin is that they adhere to the highest possible standards, even if it comes at the expense of capturing market share. As you know, there are a lot of get-rich-quick schemes in real estate with promises that with no money down, you can earn passive income and build great wealth, retire young, give up the day job and live the life you've always dreamed of. These kind of classic lines that you see everywhere. It creates a lot of noise. And though it's tempting to adopt the same or similar approaches, you know as well as I do that real estate isn't as easy as that, and that true pros have to work very hard to sustain and build a successful real estate business of any kind. In today's episode, my guest Michael Episcope describes how Origin sets itself apart from other sponsors and what it is that they have done that make them so successful. You're going to learn a lot from Michael about how to win at the real estate game, and if you would also like to learn what are the best digital marketing practices for raising capital online, go ahead and watch the whiteboard workshop that I put together for you at gowercrowd.com, where I walk you through exactly how to build best-of-class capital raising systems so that you can raise more money online for your projects too. You'll find that on the homepage and the podcast pages there at gowercrowd.com. All right, so now get ready to hear from one of the most successful real estate syndicators in the country and find out how he achieved such success. Michael Episcope, principal and co-founder at Origin Investments. Michael, what a pleasure to see you. Thank you so much for being on my podcast today. I have a question for you, and I know we prepared a little bit for this, so I can't take you by surprise by it again. But as you now know, Origin and yourself are probably one of the most highly regarded commercial real estate companies in the country, crowdfunding real estate deals. And what I wanted to ask you was, first of all, if I told you that, would you believe me? And secondly, whether or not you do, why do you suppose that is?
Well, first of all, thank you for having me on the show. Would I believe you? Yes. I mean, it's kind of like we have to remember how far we've come. My partner and I are very much wired in the same way, in the sense that you always want to be more, winning. And sometimes you have to not only look in the out the front window, but you also have to look in the rearview mirror sometimes and see who you pass. But we didn't really start to become the top firm in the industry, and that wasn't really our goal all around. Our goal was really to just produce a great product and produce fantastic investments and produce returns, service, everything that comes along with having a great experience as an investor. And that started more than a decade ago, because when we started Origin, at the time it was very novel, because we were starting a firm around this concept that we were building an institutional firm for individual investors. And today that's almost cliche because everybody uses that. But I will say 12, 13 years ago, it wasn't. And when my partner and I, we both were high net worth investors coming out of the trading world, we were investing in different areas, and everything we came across, we're like, we can do a better job. We can do a better job. And so we were kind of forced to build it. And that's what we saw in the market was just anybody who was going after the retail market. They were a very different group, like the non-traded REITs, et cetera. who were going after the individuals versus the institutions. And so we wanted to really bring them together and build a platform around that notion that individuals just deserve better. They deserve the same service, the same team, the same quality deals. And it was quite easy in the beginning because we were just two individuals who wanted to invest a significant portion of our wealth into real estate. And that's how we wanted to protect and grow it. And then over time, that's really what has helped us attract a lot more investment partners to our platform. But that's how it started. Was we didn't start out to say, well, we want to build a crowdfunding business, or we want to build a fund business, and we want to have 1,000 partners. We started out with our own capital. And when you make decisions in hiring the team and service, and you're in the seat of the investor all the time, the decisions are actually pretty easy. And I think the fact that we started out as an established platform going into 2012, 13, when the Jobs Act had changed the industry, gave us a distinct advantage. And I still remember people calling us up and talking to us and saying, Origin feels different. It just feels different. And I said, okay, well, it should, because we are in that sense, but it's definitely resonated with a lot of people. So we've been blessed.
So it's interesting you say that feels different. Let's kind of drill down on that a little bit. When I first came to America, I used to do house cleaning. I used to clean houses. And I remember that my clients could tell the difference if I had moved the furniture and vacuumed under the furniture and then put it back. There was something that they could feel about the room when I had taken that extra degree of care. Even if I had not moved it, it seemed like it looked good to me.
Yeah.
So I'd like to drill down on that kind of furniture moving idea, right? From your perspective, because when you say people just said you seem different or feel different, what is it? What is that furniture moving? And I've actually got one question for you. You talked about not having gotcha moments. Tell me about those gotcha moments, because that's a bit like moving the furniture and finding some crumbs underneath it.
Yeah, and I'll get to the gotcha moments in a second. But
sure.
Building an investment firm, no different than cleaning the room, the furniture. In many ways, there's 1,000 different decisions to make along the way, and those decisions are everything from how you address your strategy, what investments you're going to be in, how you build your team, how you build your infrastructure, what terms you put in your PPM, how you market, there are literally, over the last 13 years, thousands and thousands of decisions that we've had to make. And they're not all black and white. And you look at what your competitors are doing and what you're doing and who's doing well in the market and who you want to emulate. And you come back to, doing the right thing. And so making sure that you're really, if you were an investor, how would you treat yourself, right? And what do they want to know? Because the best investors to us are people who are, they're well-informed into because this is a long-term commitment. When you get into one of our funds, and we do funds, we don't really syndicate individual deals, although we do have sidecar deals. But when people get into our funds, it's a long-term commitment. And that's why we use the term, these are our investment partners, right? It's not investment manager, but they're truly partners, and it's a partnership. And in any partnership, you want to make sure that expectations are set clearly, and that in a year or 2 years or 3 years, they're not saying, I didn't know that, I didn't know that, I didn't know that. So we've always decided that everything should go up front and center, everything, right? And I think that's very different than a lot of firms out there. And in fact, we get penalized by it sometimes, because people might say to us, well, that seems expensive. And then you dig in and you say, why? Why does that seem expensive? Well, because this firm does this. And then there's an education process that has to, that you really have to go into sometimes. But sometimes you don't even get to have that conversation, because the face of it, we don't pretend to be the low cost provider, but we're certainly commensurate with institutional pricing. And what is really hard is when you have your competitors who are out there and they're marketing in a way that might be legal, but it's disingenuous. And it's really like trying to hook them in, whether it's, the way they underwrite and the way they project returns or their fees or something like that. So we've always just established this way of doing business that is, we don't use the word transparency. We actually have a saying in our business, like you won't find that word on our website, or anything. It's about what you do and how you do it. And that's what it is. And it's really up to the investors to decide if we're being transparent, right? And transparency to me isn't hiding something on page 77 of the PPM and saying, hey, it's in there, it's written down, you should have read that, right? So any of the really important things we put in our FAQs, we put up front and center. But years ago, I remember, somebody working for us, and this really resonates throughout our firm, is he said to me, what I love working, he said, well, exactly, he said, I love working here because he had so many conversations with investors who had law backgrounds and everything. And there was never one of those gotcha moments. There was never one of those, aha, this is it on page 4 or 5 or 8 or 10. And I can tell you in a lot of products, there are gotcha moments. And so you have to almost be a forensic financial analyst to go in there and understand what you're getting into and get to the bottom of it. And we don't want that to be the case. So even with our entire investor relations team, we view it as not, a sales pitch, but an education. And so our team is there to answer questions so that people understand what they're buying, how we make money, what it is we do as a manager, what our expectations are of them and their expectations are of us.
That must be very challenging because, as you know, a lot of people, click the invest now button and they don't dive so deep, right, into a 200-page PPM. And even if they did, it's so difficult to really understand what you're looking at. Yeah. How do you deal with that? I mean, when you talk about having lawyers that come in and read through these things and their answer, how do you deal with, yeah?
Well, I'll tell you, I mean, we don't have an invest now button. We don't want that kind of business. We want our investors to have a conversation with our team, with me, my partner, our IR team, whoever it is, so that we can at least establish a relationship. Because the investor who is impulsive and gets into an investment, a 5-10 year investment, after looking at something for 4 or 5 minutes, you're setting yourself up for failure somehow, some way. And so to us, it's more important to have a conversation to make sure that everything is laid out, that this person understands us, who we are, our team, and that we're building a relationship. Because quite honestly, one of, I think, our competitive advantages is our team on all sides. And it's having that direct relationship with us, because there are a lot of big players in the market, but there are very few where you can reach out directly to the CEO of the company or the IR team or this. And so these platforms today that are going more click to invest and want to be more like stocks, it's interesting, but we've avoided that. And our model is certainly more expensive for us to operate, and it's more high touch. But I think in the long run, it's a better way of doing business, especially in private real estate.
Have you had any questions when somebody, in the course of the life of Origin, that somebody has gone into your PPM or has dug a little deeper and asked something that has given you pause for thought and that has caused you to maybe adjust something? Like, have you learned from your investors?
I think that's a good question. The answer is no, never, because every single business term that's important, we labor over, and there's always a reason. And I can go into each and every one, why we did this, and so those are important. Now, I will say that sometimes, especially as you run open-ended funds, because we went from closed-ended to open-ended, there's some terms in there that are confusing that really require people to understand, especially on the investment period. And I don't want to, get into this, but that if they're not clear about how the dividends operate and how the funding operates and trade date and record date and all these other things, they can have some confusion. And usually you can clear that up either through an article or something else. Now, I will say that, when we launched our QOZ fund, there were some investors early on who gave us some great feedback about our investment period, that we were open, and the redemption periods and things like that. And we took that to heart, and we made some changes to the PPM. And what we did is we shortened the investment period because, we have to listen to our investors as well. But it wasn't, something like, we don't think this is fair or that's not fair. It just was something from a structure standpoint that wasn't palatable for them. Because at the end of the day, if we're building a fund and people don't want to invest in it because the length is too long or something's too long, that doesn't do us any good either. So flexibility inside the fund is really important, and also listening to your customers as well. So
I actually remember you sent out a questionnaire a couple of years ago, maybe, and it seemed like it was probing for. It talked about fees and a lot of balance. It was a very interesting, obviously well thought out questionnaire. Do you remember that? And what do you remember? Were there any surprises out there?
Yes, we still refer to that, and it's very interesting because we were talking about we were looking for feedback on the guidance of fees on our fund. And what was interesting is that when you change the way that you structure fees, right? And really what you have guaranteed fees, and then you also have fees that are earned, right? Performance fees. And so you can adjust those numbers a little bit back and forth, and you can find that level where you think that, investors are like, that works for me, right? At the end of the day, you're going to get to the same place. But what we found was that investors really, more than anything, they wanted you to be aligned, right? And so my partner and I are aligned, right? In the sense that we've invested a lot of money, right? But they want you to be more aligned. They want the team there. So for a bulk, right, maybe half the compensation to be in the form of performance fees. And it's really kind of that 50-50 ratio that we came out. You have outliers on both ends. Some people, want you to work for free and then get all performance based. And then some people are, like they're fine with, doing it all transactional fee, but certainly much more in the latter. And so you have to find this balance, because most people, they understand that you have fixed costs, right? We have fixed costs, and we have a team to pay and go find these deals and do everything. And then we it's very common in our industry to have a performance fee as well. But there was a lot of great insight from that survey that we still lean on even today.
And now you mentioned that you have an institutional kind of an institutional structure, at least the benchmark. I think the implication was institutional caliber structure for private investors. So tell me something about that, because I know that you chose at one point not to go the institutional investor route, didn't you?
Yeah, and so I'll take you back to the beginning, because when you go back 12, 13 years, we started Origin back in 2007. So that's about 13 years ago now. And at that time, that's 5 years before the Jobs Act. And it was the life cycle of a typical firm was friends and family, expanding your high net worth network, and then going into the institutional world. And it was really, my partner and I, we actually did try to go that route maybe a little bit too early on in our lifestyle. But then, we kind of looked at each other and we said, this goes into 2010, 11, like, look, we're really good at this, right? Like, let's keep going in this route. And we used to get what I would say are almost love letters from some of our investors, like, thank you, and it was great. And it felt really good. And you knew that you were helping, individuals out there, like-minded individuals like us, to actually get the most out of real estate. And it felt good. And so it was really at that time that we decided to pour all of our energy and effort into the individual high net worth market and say, look, it doesn't feel good, right? We're already high net worth investors. We've already made our money. It doesn't feel good to wake up and help a pension fund make more money when we can help people who have really saved their whole life. And by the way, and run some of these other actors out of the business at that time, which were the non-traded REITs. They were the bad guys, right? They were the ones charging 15, 18, 20%, going after, grandma and grandpa and everybody, and hiding behind reporting that was so like fixed fees. And it's I can go on and on. We can have a whole conversation about that, but that's what really drove us at the time. Like, the world needed something better, and then comes along the Jobs Act. And now this idea of building an institutional firm for individual investors. Again, I said this is sort of cliche now.
Right. And so is it, are you not tempted to go after institutional capital though, now that you've built a firm like this and to, pump up is the wrong word, but to boost the funds that you have with some big institutional checks?
It's a great question. It's very tempting sometimes, but the reality is, like in any business, it's your mission that drives strategy. And our team is very committed to this idea that our mission is to transform the way individuals invest in real estate. And it goes back to what I said earlier. It feels good when you are helping like-minded individuals who have saved their whole life, who want a fair shake in real estate, who want to get the most out of real estate, and you have a great product out there. And it's not to say that we won't go to the institution someday, but this will always be our core business, right? And when you set up, especially from an infrastructure standpoint, the way we're set up in our IR department and our marketing department and our accounting and everything we do is really catered towards the individual. And when you go into the institutional environment, that's almost a company within a company, right? That's a whole nother channel. Certainly from an acquisition standpoint, they're going to go after the same deals and you can amortize your team a little bit more over that. But we have plenty of capital within the institutional world, the individual world, and we're barely tapping the surface. So, and quite honestly, Adam, from a brand or an organizational value standpoint, my partner and I, the reason why we want to go here too is a company is not just worth, especially in our industry, the assets under management, right? If we can scale and we can have 10, 15, 20,000 investors, individual investors, that's much more powerful and more valuable from a company perspective than it is having 2 or 3 institutions giving us the same amount of money. So there is when we look at this, there's a company aspect to it as well. And this came out years ago because we never set out to grow like this. We didn't set out to say, we want thousands of investors, we want this. But you get to a point where you owe it to your team to provide them opportunities and continue to grow, especially if you want to retain them. And then you owe it to your investment partners as well to hire the best team you can. And you can only do that by having larger sums of money under management. And so growth is a part of what we're doing, but it's measured growth and making sure that we don't go from being an organization that really focuses on investment returns to an asset gatherer. And that's what you see so often in the market when you look at a Blackstone of the world. They are incredible at what they do, but they buy 50 deals a month. They put out billions and billions of dollars per year. That's an asset gatherer.
But you don't compare yourself to Blackstone. They're not the benchmark that you're, or even the competition for you. Competition, if there weren't, are other development companies, right, that are raising money in the same way.
But I would define competition as when your investor, when your customer, right, is looking at you, who else are they considering? And believe it or not, there's a lot of overlap in when people are looking at us and comparing us, well, why you versus Blackstone? We don't get why us versus Fundrise. In fact, our audience doesn't overlap one iota with Fundrise. Our minimums start at $100,000. Fundrise minimums are, I don't know, I think a wonderful job, and I have a lot of respect for that company, but it's very different. So what you say isn't our competition, I would actually say is in many ways, because it's really up to the customer when they're looking and they have a choice of where do they put their $500,000 of investment capital, who do they look to and who do they compare? Right?
That's really interesting. So your competition are REITs, are they? Not other sponsors like you? Is that?
It's all of the above. Honestly, it's everything. It's the Blackstones of the world. It's the Cadres of the world. It's other sponsors out there. It's other funds. It's even outside of real estate, I would argue, because at the end of the day, the investor is looking for the benefits of real estate, right? And the benefits of the real estate, what do they want? Everybody wants income. They want to protect capital. They want to grow capital. So real estate is the widget that provides those benefits. And if they can get that through another investment category, then they will go there. Now, there are a lot of, especially in the REA world, who we focus on as well, they focus on asset allocation. So there's always going to be that element of we want 15, 20% of our portfolio in real estate, and they balance that all the time. But a lot of times individual investors, they're more agnostic and they don't follow a strict asset allocation strategy as the RIAs, and they will just look for the best available investment they can find.
So what is your communication edge in a competitive world? What is it that gives you an edge when somebody is out there looking and has never looked at real estate before, but has $500,000 they want to invest, for example?
Yeah, generally people come to us if they've never looked at real estate before. I mean, we usually, our investors have maybe they're investing for the first time, but they're looking for it. They find us in some way. You know, we talk about competitive edge as being quantifiable, right? So what is our quantifiable traits that we can say that nobody else can say? And that's something, any business, right? And so, you know, we can talk about real estate as an asset class, but everybody can talk about that, right? So the things that are quantifiable in our business are when we talk about our team, right? We have our team, nobody else does, right? The things that are quantifiable are the fact that our track record and our returns, and nobody else can say that, right? And so when we talk about those things, those are quantifiable. The fact that we have more than 1,000 investment partners, that's quantifiable. More than $1 billion, you know, so on and so forth. So when we're talking about our competitive advantage and we're speaking to investors, it's about the things that are unique to us and not real estate, all right? We will educate them, and in all of our decks and our materials and a lot of stuff, we will talk about the basics of real estate, right? But the world is this big. Then it has to be about why us? And those come down to our competitive advantages. And I would say the last one, team track record, but it's also alignment. And the fact that my partner and I, even today, like, why did we start the firm? To invest our own capital into real estate. We're still the largest investors in our company today, and I'm proud of that. And I hope we maintain that. I mean, at some point we run out of money, but it's a testament to our belief in what we're doing and our deals. And the question we used to get the most when you're talking to investors, and this is the ones who just admit, look, I trust, you know, I don't know what I'm doing. I trust you. How much are you putting in the deal, right? And that's what they want to know. And that is what matters to them. So if you're putting in a significant amount of your own capital in the deal and you have a relationship with these people, they're like, good enough for me, I'm in, if you're in. And so that is, that's not something that a lot of people can say out there, especially sponsors, because they're in the business of leveraging their capital. So they're trying to put in as little as possible to magnify the impact of other people's money.
Right, and this is what you were talking about, an alignment of interest that you build into what you're doing. So actually, when I was asking about communication, I was being a little bit more prosaic, actually. So you've described what is your edge, but how do you actually communicate that? And what I mean by that specifically, I remember, again, I went back and I had a look at our last conversation from, I think, 3 years ago, actually. And you mentioned, this is totally self-serving, by the way, to my entire audience, but you mentioned having the best ROI you had was on the marketing company that you hired to help you communicate very early on. So it's that kind of communication. What is it? Is it because you send out emails or advertise or have so good social media presence or a good educational section on your website? I mean, what is it that
it's all
moves
about
that needle?
I will tell you that I'm not a born marketer. I've certainly learned a lot about it. We have an amazing marketing director who manages a team. And it really, you know, if you go back 6, 7, 8 years ago, my partner and I were the marketers. We were the ones running out there, having lunches with everybody. And what we realized is that, look, there's got to be a way to scale this. It can't just be the two of us. And we have a great product, and the internet made so much sense, because if you have a great product and you put it in front of millions of people, they're going to buy it. And then we hired a digital marketing company to really build our assets. And our assets were our website, to rebrand us, design us. And that was the starting point, right? But that really is the starting point, because this is not a business where if you build it, they will come, right? And so the unique thing to us was we had great messaging. We had a great story. We had the things that you need to attract people and pique their attention, but then come in and have more depth to it as well. So, you know, what we've done since then is quite a bit. And everybody in our, at Origin has really become a a content creator as well. And this is something that we live and we breathe, because content, what we try to do early on is even outsource some of the content. And what you realize is that people don't have the domain knowledge that you do. They're not going to write in your voice. They're not going to necessarily be inspired by the same thing. So we had to write it inside Origin. And so everybody has now become a content producer, and that's on our acquisitions team, on our marketing team, on our IR team, in the accounting group, in the legal group. Everybody at Origin contributes to the content in some way, shape, or form, in the written content. We have more than 400 pieces of original content now. And these are all things that when we get questions from investors, what's confusing? What do they need to know? Is it catch-ups? Is it waterfalls? All this lingo that you never thought you wanted to know. But then you have to distribute to them. You have to get it through them and nurture campaigns. You have to create videos, et cetera. You have to build a database. You have to have calls to action on it. And so these are all the things that it's really, I mean, you're in the business as well, and you know what a holistic view this is to making it work. It's not simple, and it's not something that you do, you say, I'll build it and then give it 3 months and it's not working. You have to make a commitment to this. And we did in the beginning. And we remember, once we went down this path, we are committed. And we started out with getting 2 to 3 to 4 leads a week. And that went up to 20 leads, to 50, 100. We've had weeks where we've had thousands and thousands of leads. And so it's certainly been a building process. And, within the group of leads that we get, there are people who are just interested in learning more about real estate. I would say that we educate quite a bit of the student community. I get emails on my LinkedIn all the time from students thanking me for this. This is great. This is better than the materials I get at school. People in the real estate community, they feel like we're the gold standard of information out there, but it's because it's written by experts who know what they're talking about and who are in the weeds and go to another level, right? And then we get investors, and whether they invest with us or somebody else, they're just appreciative of the depth of information and the amount of information and how we put it out. So does that answer your question?
Absolutely. Yes, it does. And the other thing, no, perfect. I'm going to quote you all over the place with everything you've just said, by the way, because it's exactly what I'm talking about. But you also make this intelligence accessible. And one of the biggest challenges that I find is that real estate sponsors really struggle to understand how powerful actually communicating online is and can be. When you're talking, most of the people I know have been in real estate for 30 plus years, right? I mean, it's this, the old school kind of thing. And everyone's used to raising money online, raising money in person. Mm-hmm. So what do you think it is about your background that made that so clear, just so obvious that you could leverage the internet? Is it because of your background trading, or the way that your edge in that world was flipped by computers, etc.?
I would say, I mean, a lot of it is common sense, honestly, and it's being an investor. And it's, over the years, I read marketing materials. I know what I react to. And you have to just kind of cater to the philosophy that nobody reads anything you put out, and people have very short time spans. So you have to give them the information they're looking for quickly in bullet points, highlight, bold, that's it. There are times to do long form pieces of content, but when you're marketing to people, what do you want them to know and get to them quickly? Because they are, I can tell you in the morning, what do I do when I wake up? Like everybody else, I go through my emails, select, delete, get rid of them all, right? And it's a lot of noise. And in today's day and age, it's very difficult to figure out ways to stand out with email. And that's why you have to go to other forms of communication, webinars, podcasts, video, even personalized emails, things like that. And so you have to grab people's attention and say, hey, look at this, right? And by the way, there's a lot of investors out there, even in today's day and age. There's a very fine line between today's sort of what I'll call crowdfunding world and the way business was done 10 years ago, right? We generate a lot of leads, right? And I would say that we're not really in crowdfunding, we're a lead generation machine. But many times, until I pick up the phone or somebody in IR picks up the phone and says, hey, we got an interesting deal, they're not going to look at your stuff, right? But when you pick up the phone and you say that, they're like, I'm listening, right? I know who you are, I like you, all this, and then they listen. And so, it's hard to cut through that, and how to know, how do you be somewhat of a passive voice where you're not being intrusive, right? Nobody wants to be called on their phone just out of the blue, but how do you also get people's attention? And that's an art that you just, have to continually deal with, and make sure that you're presenting information that is a way to capture their attention in a world that's busy.
That's really the point, isn't it? That online you can establish a relationship with somebody with all the content that you have. You can establish a relationship, they can get to know you. So when you do make that call, they already know you, right?
Yeah.
You don't have to go through, this is our background, this is what we've done, this is how we operate, etc. They already know that. Now you've got more of an intimate a level of communication, that first call. But let's pivot a little bit. And I'd like to ask you, we would be remiss if we didn't talk a little bit about the world today and how we see the short term, right? Post COVID. I would love not to make this, I would love not to date stamp this, this podcast, but we have to do that. But so what are the biggest challenges today for Origin and for you? And I would precede that by saying I read your email today on preferred equity, which is very interesting.
So,
tell me about
that. There's a long form of that coming out this weekend on Origin Insights, and it's all about how we're navigating, because the challenge in today's market is that you've had the economic fundamentals that have changed drastically for the worse, right? You've had unemployment go from 4% to 13%. You have all of this uncertainty with the virus now acting back up. They don't know if there's going to be another shutdown. On the other side of the equation, you haven't really had any price movement because real estate prices move slowly. This is a private market. In the public market, they're down significantly. And you can say that they were much higher before they started in this. And when we sort of look at all of these different markets together in tandem to get to pricing. But the private market, there's not a lot of opportunity on that side, because if your fundamentals have deteriorated, but your prices haven't, and you choose to transact at those prices today, then your go forward IRR is going to be incredibly low. You're basically paying too much for an asset. And one of our core propositions is buying right. And so when we see value and price really diverge from one another, you have to either say, if it's a market like this, you either sit out or you find a way in an investment strategy where you can make money. And so for us today, it's preferred equity. And it makes so much sense because the market is still operating. There's deals getting done, but preferred equity, when we're, calling it, kind of in a lender-like position, and preferred equity, for maybe those who don't know, it sits between the debt and the equity, and we might fill the capital structure between 60 and 80%. In a situation like that, right, where the lenders have pulled back, it creates a great opportunity, and we might generate yields 12 to 14%. But in assets we know, we understand, that we want to own, with sponsors we believe in, who can create value in these deals as well. And you're protected in the sense that the asset can lose 20% of its value before your first dollar is at risk. So to us, generating a 12, 13, 14% yield in a protected position in a market with so much uncertainty is the right way to do business. And interesting enough, our Income Plus fund, we have the ability to do both direct equity and preferred equity. That's always been a component. And now it's just a matter of where do you tilt the fund, right? Which way? And so in today's day and age, we're choosing to tilt it towards preferred equity because that's where we can continue to deliver our yield and build the fund's value as well.
And just to clarify, for the one person who's listening that doesn't actually know what preferred equity is, and I'm just double checking myself actually, because the definition has changed over the years a little bit. It's become more nuanced, particularly since the last downturn. But preferred equity actually behaves like debt, doesn't it? It's kind of replaced mezzanine. You don't have a piece of the back end. It's strictly an interest paid on with rights to take over a project if you don't get paid, basically.
Yes, but it's also a negotiation, so it depends. You can mezzanine debt is really more like debt in the sense, and preferred equity is you're a position in the equity structure. You can negotiate depreciation in that position. You can negotiate upside, right? It's a negotiation, and you sit. Equity is subordinated to you, so you get paid in priority over equity. But those things can be negotiated, and we negotiate those as well. So we might say, look, we're not going to charge 12 to 14%. We actually believe in the upside here, and the 12 to 14% might give the sponsor heartache. So we'll come in at 8 to 10% and take 20 to 25% of the upside for that. And that deal might be more palatable to that person. And if we can negotiate depreciation, et cetera, then you can make preferred equity a very tax efficient vehicle as well. So it is very flexible. And the other thing that we try to do in all of our deals, because again, these are generally multifamily projects in our target markets with sponsors, we negotiate a right of first offer, meaning we can buy the property and flip into the equity position if and when we see the time is right. So those are some things that we do within our structures to not only protect ourselves, but also, if things start turning around, we want to be in the equity, and these are assets we want to own forever.
And you have, with preferred equity versus any true debt position, you have the rights to take over a project, right? That's the distinction between another distinction between preferred equity and mezz debt. Not foreclosure rights, actual.
Yes, actually in preferred equity, you can actually step into the LLC. It's UCC code. But it's not ever our intent, right? We're not a loan to own shop. And in fact, we don't look at, like a bank is very different. A bank looks to the collateral and the borrower for its repayment, right? And they are scared to death to take control of the property, right? We don't mind, but we're working with sponsors and developers out there who have a track record and a history of doing the right things, building value, finishing on time, on budget, et cetera. And so that's how we want to see this go. But we also have the expertise, if we need to step in and either help them or step in and take over the project.
And this is the income fund, right, Michael?
This is the income fund in the preferred equity side, but we also do direct development in our qualified opportunity zone fund.
Right. But the income fund, the reason I asked that is that you look to third-party sponsors. Right.
Yes.
Just preferred equity, not regular equity as well.
On the equity side, we are direct buyers, core plus and value added opportunities on that side that we own and we operate. We manage asset manage about 4,000 units today across the multifamily.
What are the biggest challenges of today for you? What are you finding, like dealing with the market now, but also navigating short midterm, I suppose?
I mean, the biggest challenges are kind of what we've talked about, where you have the virus that's still here, you have the market opening, you haven't had prices readjust, you have a slowdown in transactions. So, I think most firms are kind of in our position as well. We were having an amazing first quarter and record volume and things like, and there was some equilibrium in the market. Now that has come to a standstill. And so for our firm itself, I mean,
what's come to a standstill? What has come to a standstill?
They're starting to pick up,
right.
But when your business is, we are a fund, our acquisition team is out there and they're looking for deals. And when there's not a lot of deals out there or, at the right price and you're not doing anything. So I think the challenge, if I have to really call it, it's about keeping your team motivated even through difficult times like this. And our team has been amazing through this time and they've been great and they've been keeping it up. But clearly, everybody in March and April and even May, they took one to the chin a little bit, and we as a firm really, we went from this high growth. And even when you're fine from a revenue standpoint, and we don't have private equity at our firm, we don't, we've always believed in measured growth and we're going to do fine. Everybody loves growth and they thrive on growth. And we had all of this energy in January and February and everybody was on cloud nine. And literally I was about to take the IR team to Vegas the week of March 9th to celebrate January and February and the end of December, and we had to cancel that trip. And then it was just, holy cow, batten down the hatches, the storm is coming. But across, the marketing had to stop, the fundraising had to stop, the acquisitions had to stop. So that's been a challenging, when you and we're a microcosm of the economy, then you have to start that back up again, right? And so that, I think, has been one of the challenges, and we will. And I know I was thinking about this today for some reason, we have an annual event, and I can't wait to stand in front of, just hundreds of people who are at our annual event and talk about and have a time when this is in the rearview mirror.
Oh, gosh.
It will eventually. It will be in the rearview mirror, and hopefully sooner than later, and we get life back to normal.
Right. Where are let's wrap up. I've got 3 sign-off questions, but one question before I ask you my 3 sign-off questions. Where do you see the biggest opportunities today?
So the biggest, preferred equity. That's where I see it, and two areas. For us, it's in preferred equities, and certainly when you go back to March and April, the biggest opportunities were in the public markets, because we also run a public side, and so anytime you have your liquid investments are going to reprice first, right? And what you saw in that area was you saw them actually, sell off dramatically, way beyond. And there was a huge opportunity. When you looked at private market pricing relative to public market pricing, there was a great opportunity to jump in to some of the sectors that have much stronger secular growth behind them, industrial, data centers, cell towers, et cetera. And those all sold off on those side, and because they're public. And so I think that you always have this roller coaster between public and private. Private takes longer to correct, and it might come in 6, 12, 18 months, and it might not come. We might just have the fundamentals catch up to the pricing today and be sitting here for a while. But I think that's where the biggest opportunities have been, is looking at, comparing the two, and then, jumping into the public equity side on the REIT side.
3 sign-off questions.
Okay.
I ask all of my guests.
Ready.
1, what are your key daily habits, personal key daily habits that make you successful?
Oh, I think you asked me this on the last one.
I think I did. As I typed them out now, I couldn't remember if I had or not. But maybe they've changed.
I have, I'm a creature of habit. I have a lot of routines. I wake up early. I read all the market information in the morning. I have my coffee. I walk. I listen to podcasts. And really, it's just about, keeping my team, making sure that the people who report to me have clarity and understand their roles in their day-to-day, and making sure that the ship is moving in the right direction. It's moving quickly. I have a great partner as well, and he manages his team. But I also, I have a good work-life balance at this stage in my career as well. So I have 3 young boys. You and I talked about that. And you can't go 100% pedal to the metal. So if you're happy at home, you're happy at work. And I fundamentally believe that with our team and everything else. So I do whatever I can to spend time with them, watching baseball, watching swimming, going to their concerts. It's one of these moments in time that, it's a fleeting moment, and you want to make sure that you capture it there. But, and making my wife happy too, right? So
happy wife, happy life.
Yeah, but I don't have, I'm a sort of a creature of habit, but every day waking up at the same time, have my coffee, eat the same, this and that. So,
do you use social media?
I do, to a degree. Our marketing department uses it quite a bit, but I use LinkedIn more than anything. I'm off of Facebook. I don't really, I don't like Facebook at all. But LinkedIn, I absolutely do. And I have a tremendous amount of connections there. And that's how I really, I don't know, new leads, things like that, talking to people and business community things. That
Interesting.
Yeah.
And so what's been second question, what's been the hardest lesson now that being an online company in part, what's been the hardest lesson you've learned online?
Oh, God, good question. The hardest lesson I've learned online. I don't know that I have a single lesson. I mean, being online is hard. I don't know where to go with that one. I mean,
In what way hard? In what way is it hard?
well,
Having an online, company
I think it's
that's
hard to, we talked about this earlier, to sift through the noise and stand out and really, people approach this industry with skepticism, as they should. And I don't want to say it's hard to stay in our lane and kind of do the right thing, but it's frustrating sometimes when you see, and you and I talked about this earlier, when you see others marketing in a way or advertising in a way that is legal, but it may not be accurate, and there's a lot, when you peel back the onion and stuff. And so, we've had a lot of these discussions, and we just choose to do business in the way we do and keep our, kind of sights on the long run and want the right investment partners with us.
Okay, last question. Advice for somebody looking to invest in real estate today. What would be your advice today, particularly?
My advice, I mean, real estate is always a great investment. It's not one of those things that can be timed. So if you want to invest in real estate today, it should be a long-term commitment over the next 5 or 10 years. Read, get to know your sponsor, get to know the people. And that's the thing. And don't go out there and look at IRRs and try to make decisions based on who's got the highest IRR deal, because this is a relationship business. And I've written this so many times, Adam. Who you invest with matters more than anything. And I've made those mistakes for other people. And I've gone and I've fallen for the bright and shiny, only to wind up, in disastrous situations, and it doesn't work out. And a 25% return doesn't go to a 12% return when it goes wrong. So don't, when you start looking at one is 10% and one is 15% and one is 20%, that means nothing. Get to know the people, talk to them, find out who you're comfortable with. If they're good, they will generate the highest risk-adjusted returns for your money, and it'll be worth it, right? You will sleep better at night, and there's value in that. So it's who, right? So focus on that, and everything else will fall into place.
Michael Episcope, Origin Investments. What a pleasure having you on. Thank you so much for your time today.
Thank you, Adam. You're too kind. Appreciate it.
That was Michael Episcope, principal and co-founder at Origin Investments. And here's a quick shout out before I wrap up today to Bart, who corrected me last week for the way in which I mislabeled just about everything when asking you if you wouldn't mind leaving an iTunes review. I stand corrected, and so with greater precision ask that if you enjoyed today's episode, please rate and review the podcast on Apple Podcasts, and be sure to hit the subscribe button while you're there so you don't miss any future episodes. You can find links to Apple Podcast and to all other podcast platforms for that matter on the podcast page at gowercrowd.com, where you'll also find links to Michael and to Origin Investments. All right, that's it. Thank you so much for listening, and thank you, Michael Episcope. It was a pleasure to meet you via Zoom. We haven't met before in that way. I hope it is the first of many opportunities to do so. Thanks so much for joining me today. That's all for this episode. I'll see you next time, and in the meantime, stay well. And for now, this is Dr. Adam Gower signing off.